Hey there everybody, Mark Gomes, PTT Research. How's it going? Back again with another PTT series. Our gift to you, our customers, for being with us during our first year in official existence. We're going to go through just quickly today's market action, and you can see there's a lot of red on the screen. It was a brutal day on the markets, and not for everybody though. Okay, it was actually a very good day for members of PTT who were following the rules of the methodology to a T, and we'll walk you through that. So, as I've been saying for a while, we wanted to be hedged. I've provided some yellow alerts in the past. Back in November, we provided a yellow alert, and the market ended up being down a few months later. Provided another yellow alert back in early July, and the market tanked pretty good. We almost issued a yellow alert, and if you remember the videos, you could tell that I was debating whether we should have another yellow alert. And the main reason I wasn't sure was we hadn't really gotten back up to these higher levels, but I felt that fundamentally there was something wrong, so you could feel me waffling, right? And so over the last few months, whether we had a yellow alert or not, the advice has been to have some protection in place, some hedges. And certainly as the market started to break, my last few videocasts have espoused the notion of being hedged. So let's walk through what that looked like today. Okay? So, under the rules of the methodology, somebody with a $100,000 portfolio would have 10 grand in QAD, 10 in Glue, 7 in Jack Pacific, 7 in Mattersight, 1,000 in AeroGrow. Okay? Rules of the methodology, check it out if you haven't seen it. Very clear. We've been talking about this for a while, so these are definitely the numbers we've been dealing with. And of course, that only leaves us $35,000 long. Now, as I stated, as we reached market peaks and customers were perplexed as to why we only had $35,000 worth of picks for a $100,000 portfolio, the reason was simple. Because the methodology, excuse for that, here we go, because the methodology makes sure that we're cautious at tops. Okay? At this time last year, or even a couple of years ago, somewhere in this vicinity here, on the April time frame, I recall, showing you in a different video at one point that we had about 80+% of our portfolio in picks, and Hymax was one of those picks, and we had some good stuff in there, right? And it was because the market was still on the upslope. So the methodology protects you at the top by making sure that your position sizes are relatively small. But the methodology also protects you because we get these yellow alerts. The risk reward's too high, right? If we bring this out to 3-day chart, you can see, look how high we are in our channel. Okay, and this isn't necessarily a perfect channel. This is a gauge. This is a gauge of how high or low the market is. You see we went below this gauge back here, back in 2009, and of course it ended up being a great buying opportunity. The lower it went, the better the buying opportunity was, right? Unfortunately for some people, they were actually selling. You see the volume actually ticked up as the market went down, down, down. So there's more and more selling as the market went down instead of what should have been happening, which was should have been more buying because the opportunity was greater. Okay? And up here, the opportunity was greater to take profits and have a smaller portfolio. And so that's a big part of why we only have 35,000 here. Now, it also says to be hedged, and I've been talking about being hedged. And so let's go into the specifics of that. Now, personally, there's a couple ways you can do this. One, you can just take this 35 grand and you can split it up evenly amongst these two picks, and that will get you to where you need to go in this regard. So if we get our formula in here for how much money we made, okay, copy that down, alright, and we want to get a summary of our gains and losses. So if you had the methodology's worth of picks today, you lost $868. It's actually not bad on 100 grand. That's less than 1%. See, the S&P, the Dow, and the NASDAQ were all down about 2%. And in fact, the Russell was down more than that at 2.66, which is what I like to watch because a lot of our picks are Russell type stocks. Okay, so not good, but not bad. Definitely much better than what the market did. So we got some nice protection by being adherent to the rules of the methodology. Now, let's check out what happened here. Okay, we got our summary of our two hedges, a $750 profit to offset that $868 loss. It almost brings us to break even for the day based on these hedges. Okay, now if we take these 35,000 and then make this US dollar, this is how many dollars we have left. We want to take the 100,000 minus the 35 hedge minus the 35 investments, and that left us 30,000 in cash, which during bad times we want to put in UUP, because during bad times when the market is dropping, we feel confident that the market is going to be dropping, the US dollar will generally rise. And I'm particularly been bullish about the US dollar of late if you've been watching the video series, and man, has that worked out. We see here, as I'm sure you've seen plenty of times already, it's just ripped over the last few months, ever since my yellow alert back in July. Okay, so that's worked out great. You've had cash, but this cash being put in UUP basically acts like an ultra UUP, actually acts like double dollars. And so this big 5 to 10% move we had in the dollar gave you a nice 5 to 10% profit in 30% of your portfolio. In addition to the 10+% profit that you've made on your hedges here, because the Russell and FXI, the Chinese large cap index, have done awful of late. They've been collapsing. Okay? And when you're short something that's dropping, you make a profit. So you can see the majority of our portfolio has actually been making a profit while our core and speculative and momentum picks have been falling in value. Now, of course, we don't want to sell these stocks because we really like their prospects to go up in value. The underlying value of those companies, in my opinion, is much higher than their stock prices reflect. so we want to own them. And that's why we need hedges to protect us in case the market goes down. Not in case these stocks lose value. If I believe that these companies are no longer worth owning, then I'll specifically make a call to wave the white flag and get out. But as of right now, I don't feel that's the case with any of these picks. They've all been performing good. The news has been positive on every single one of these picks. We haven't been given any reason to doubt that these companies are doing well. And so we use these hedges, and they've been working fantastically. Now, today in particular, we had that 750 gain on our Russell and China hedges. And you'll notice that our $30,000 position we'll update this in UUP gave us a $90 profit. 90 plus 750 is 840, which is almost fully makes up for the loss in our portfolio. Brings us very close to even. We can just add that all up here. Okay, 26 bucks. That's what we'd be down today. 26 bucks. Negative 0.03%. Okay, now that's just using standard hedges, one for one, dollar for dollar, 35 grand for 35 grand, and having the rest in the UUP. Okay, get rid of that number. It's meaningless. Okay, now how did my portfolio make money today? And that goes back to the lesson I taught not too long ago about beta weighting. And for those of you who don't recall, beta is a measure of volatility. It tells you how much of a stock's movement is based on the stock market's movement as opposed to its own merits. And we see in particular here, at 1-to-1, right? In this example, we did a 1-to-1 hedge. So this is basically assuming a beta of 1 in terms of volatility, in terms of protecting ourselves against downside risk at a particular point in time where we feel strongly that the market is going to drop. We want to use beta instead, not 1-to-1, but something that will reflect the volatility of the stocks we own. And in particular, you notice that glue has a very, very high beta, which will greatly increase the size of our hedges. Now, what I'm going to tell you is that at this point in time, because the market has dropped so much, that I'm not using a full hedge, a full beta hedge. I do that closer to market peaks. So when we have a yellow alert, when I'm really concerned that we're toppy out, that's when a full beta hedge becomes a lot more prudent. All right, so let's see what a prudent hedge is at this point in time. All right, so coming in today, by the way, we had a really sharp move yesterday in the market to the upside, and I was unconvinced that we were going to follow through. Just a hunch. The difference between hedging 35,000 and 64,000, yes, it makes a big difference, but at the end of the day, it's really, the difference between making 750 bucks and making something like 1,400 bucks. All right. So it's like a $650 difference on a $100,000 portfolio. It's not the end of the world, right? This is more art than science at this point. Okay. The rules of the methodology have gotten us most of the way there. It has gotten us close to profitability, and that's all you can ask for on a bloodbath like today. But then you can use a little bit of judgment, right? And this is where it can be fun. By sticking to the rules of the methodology, you might be bored. You might think the market's not fun. I don't want to stick to the rules. I want to make some of my own decisions. Okay, well, here's where you can make some of your own decisions. Here's where I've made some of mine. So QADs, I went to Yahoo Finance for this. Different sources might give you slightly different numbers. I just want to get in the ballpark. QAD, beta of 1.36. Okay, they've got a lot of cash, a lot of assets. The market's come down a lot. So I decided that I was only going to use a 1-to-1 hedge. 10,000 QAD, 10,000 hedge. And that's where I'm at on QAD right now. Okay. Similarly on glue, with a beta of 4, when you have a high beta, the stock has to go up an awful lot, has to go up 4 times more than the market if the market starts to rip. And because the market has gone down so much, I decided that rather than using 3.98 for my beta, I'm currently using 2.8. And that's going to come down too. Frankly, if I wasn't busy near the market close today, I probably would have trimmed my hedge, trimmed this number down a bit more, considering that the market took another tumble, and because we've gone down so far, and because glue has come down so far, on the back of those negative reports from the street sweeper, which has been implicated with some less than scrupulous dealings. I'm not saying that, but take a look at our article, and it links to some other person's work who shows some of those links. Okay, what I'm going to tell you, regardless of the morals of the street sweeper, their findings were absolutely amateurish, in my opinion. Okay, showed absolutely no knowledge of what this company's all about. So when the stock is down heavily and the market's down heavily, there's less need for a hedge, and this is why I chose to only go with a 2.8 beta weighting instead of a 3.9. And again, this is likely to drop further. I would have liked an opportunity to have done that today. We'll see how that plays out tomorrow. But again, it's not going to make a major difference at the end of the day. A few $100. This is what kind of makes it fun, right? Okay, so Jack's Pacific, Mattersight, and Arrowgrow. These are all in red. The reason is that each one of these stocks are listed as having a beta of less than 1. The only time that I will pay heed to a beta of less than 1 is if the company has a tremendous amount of cash or other assets on the balance sheet. Huge book value relative to its core value. And that's not the case in any of these picks. In fact, it's quite the opposite. So I always default to a beta of 1 in these cases. Okay, which means that my hedge is going to be equal to my investment. Boom. Alright, now we have our actual hedge amounts. We just need to add it all up. $53,000. Okay? And that compares to the $35,000 that we used on a 1-to-1 basis. So, to split that up between our Russell and our China, gets us at the $53,000. Now look what happened. And by the way, it decreased our UUP hedge, and the UUP was up today. So our gain in UUP dropped. But our gain in the short positions on the Russell and China ETFs increased dramatically from 750 to almost 1150. And now, because of this positioning, because of using the methodology and our yellow alerts, our concern at the tops, our risk-reward view on the IWM, seeing that we're at a very precarious risk-reward situation. So we had yellow alerts. We knew we were near a top here based on our risk-reward charts. And pulling that all together, using all that knowledge of the methodology, we came out today in our $100,000 portfolio with a profit of $307. Only 0.3%. But to make a profit on a day where blood was in the streets to the tune of 2.66% on the Russell, and a day where our picks were all down by varying degrees. And one thing you'll notice here, by the way, is that while glue was down more than the Russell, it greatly outperformed its beta. Okay, when the Russell is down 2.5%, you have to expect glue is going to be down somewhere between 5 and 10%. So to be only down 3.5% on a day like this is actually bullish. QAD outperformed the market by a little bit. JAX was basically a hero on a day like this to be only down 1%. Mattersight was actually down a lot more earlier in the day and came roaring back at the end of the day. Buyers were coming in. And the volume, by the way, has been very, very low on these last 2 days of declines. So Mattersight was on the rise on some decent volume and just plummeted out of nowhere on a few tens of thousands of shares. Okay? Not even $1 million worth of Mattersight drove the stock down over 10% in a 2-day period. So that's just silliness in my book. And it's silliness anyways, because the value of the company, to me, is what should determine the price of the stock, not the volume, not the stock market movement. And then, of course, AeroGrow, our friends at AeroGrow, this stock has been getting absolutely pummeled. And thank goodness it's only a 1% position, because this thing has completely fallen out of bed. I'm sticking with it, and hopefully that works out, because everything I see there warrants hanging in there. They're doing a great job. Just take a look at my last alerts on this. Nothing has changed there. They're into Walmart, Costco, Target. The list goes on. They're doing a great job there, and until I see otherwise, I'm going to stick with it. Now, if we see some trouble come along the way, maybe we're going to want to get out of the way. But I don't see any reason to get out of the way of this pick, so I'm sticking with it, particularly because it's only a $1,000 position out of 100,000. So the damage it can do to our portfolio is minimal, even if we get crushed there. All right, so it wasn't a bad day, all things considered. Right, our picks did pretty much what the market did overall. If we take a look at an average 2.8%, and of course the Russell was down 2.7%. All right, so certainly nothing to worry about with our picks in particular. It's just that the market was down. And on a beta-weighted basis, we did much better, and that's why when we have these hedges in place, put our cash into UUP, we actually squeaked out a gain today. Okay? Now, if you didn't squeeze out a gain today, go back to the methodology, learn these lessons. We just spelled it out in this lesson right here. Hopefully all of this made sense, particularly the position sizings. That's number one. That's paramount. Everybody should know this. And from there, it's just a matter of how to allocate the rest of your money, right? Hedging by shorting some ETFs will make the difference. So if you don't understand that, definitely learn about it, because you can see what a difference it made today. Anybody that was 100% invested in our picks was down an average of 2.8%, which on a $100,000 portfolio was $2,800 in the hole today instead of being up 300. It's a big difference. It makes a huge difference over time to not take these losses, particularly since they've been going on, right? These losses have been going on for several weeks. And this was just one day of this huge drop. So nobody likes to get pummeled, but being hedged has enabled us to maintain our capital through this decline. And indeed, I'm still near my highs for the year because of those yellow alerts and because of the hedges that we've been talking about. So keep that in mind. One last thing. I have people asking me, oh, I didn't put my hedges in place before. Should I do it now? Another question is, is it time for a red alert? The question to either of those is no. The red alert is certainly pending. I do see a lot of problems out there. I see a lot of chinks in the armor, but I don't see anything collapsing as of yet. Okay? Until we see cause for alarm on that level, we have to assume that the market is still going to churn a little bit, that there's going to be enough people who feel optimistic that are going to start buying this dip. Okay? And maybe we're forming a rounding pattern here. It certainly looks like it, and I think that's warranted by the fundamentals. But any rounding pattern has its ups and downs, and indeed, if common sense prevails, then some of these bulls are going to step in here unless something major happens. There's no guarantee. But at some point, it might be here or it might be here. There's no telling when it might happen, but there's going to be a bounce of some sort, right? Unless there's some kind of cataclysmic event that brings us down into these levels. And I don't want to play the game of what if. All I know is up here, the market was clearly at a risky level, and down here you'd be chasing the hedges that have been going up, and you never want to chase. That's another rule in methodology, right? So there's a lot of rules that you need to balance in the methodology, and so it's a lot of work, but the methodology is only 30 pages and encapsulates 20 years of work that I put into learning all of that stuff that my mentors taught me and that I learned through researching the methods of Peter Lynch and Warren Buffett. And that's why I say, through ups and downs, through thick and thin, PTT Research is here to teach you the lessons that made Peter Lynch rich and Warren Buffett a billionaire. Stick with us, and we'll stick with you to teach you more of those lessons on how to make millions, keep your millions on bad days like this, and who knows, maybe someday you too will be a billionaire like Buffett. So until next time, this is Mark Gomes saying, I wish you great prosperity and take care.